Well, thank you, Paige. Hello, everyone, and thank you for joining us today. In preparing reserve studies, we often come across managers and boards looking for assistance in the larger subject of financial accountability in the process of trying to do the right thing for their association. So we connected with Russell Munns for this webinar to fill in this gap and give you a program on how you can lead a fiscally responsible association. So there are a lot of challenges you face in handling the finances of an association. That means correctly and consistently handling delinquencies, paying the bills, best practices to prevent embezzlement, managing payroll, making operating versus reserves decisions. Now, you all know those challenges better than I do because I stay in the subject of budgets and reserves. So as we go through today's webinar, because you're muted to keep background noise to a minimum, if Russell or I ever need your feedback, we'll ask for a hands raised. And you do that by clicking the hands raised icon in your control panel that looks like the one I'm showing on screen. So let's practice that. Grab your mouse and give me a click on the hands raised icon in your control panel if you're ready for us to start the presentation. Okay, I'm seeing hands get clicked up. Very nice. All up and down the list. Great. Okay, I'm going to click hands down. There we go. And we're here today because we believe, like famous investor Warren Buffett said, that while we learn from the mistakes we make, it's better to learn from the mistakes of others. So Russell, kick us off by telling us how our audience today can benefit by learning from the mistakes the others have made, the other boards you've seen in your years of experience.
Thanks, Robert, and hello, everyone. And especially when it's dealing with money, it's better to learn from others' mistakes. So we have to remember, whether you're a board member or manager, you're a fiduciary, someone who's entrusted with the care of money or property, both in our case. And as fiduciaries, your most important job is to protect the community's assets. Going back to Warren Buffett, his #1 rule of investing is don't lose money. And so we as fiduciaries must prevent the loss of money, and the greatest threat to losing money is embezzlement. We have to learn how to spot it and prevent it from happening. If you don't watch out, it can even happen at your community. Crime reports across the country prove this point time and again. And I've studied embezzlement in this industry and have written over 20 case studies on this topic, and I wanted to start off today's webinar with 2 of them. So case #1 is from a board member, a former board president in Florida who stole approximately $200,000 from 2010 to 2014. The sheriff's office stated inattentive financial record processing was a major reason for the theft. Okay, so what does that mean? This president was responsible for paying the bills without other signers. And she did it by writing 85 fraudulent checks made out to names similar to her own. And you do the crime, you do the time. And she was arrested and sentenced to 5 years in prison, 15 years of probation, and had to pay $192,000 in restitution. And just so we don't just think it's board members, property managers can also be part of this problem. So in Colorado, there was an on-site manager who stole approximately $308,000 between 2004 and 2009. So how did she do it? She issued duplicate payroll, bonus, and other checks of about $115,000. She issued herself checks totaling over $79,000 and listing them as a payment to a vendor. And she forged the signature of the board VP on 71 checks. She also withdrew large amounts from an ATM with a debit card, and she used credit cards in her and the community's name to make personal charges. She too pled guilty of felony theft charges. So embezzlement may not happen at your community, but from these worst case scenarios, we learn what not to do. And it's from this that best practices are born. So now we're going to talk about the best practices for financial management, which will, as a result, safeguard your community's funds. So we'll repeat this one a couple of times, but having more than one person authorizing payments is a good place to start. In both of these case studies, the perpetrators were writing checks, fraudulent checks. The next thing to do is review the financial reports, which is going to, should allow you to spot some things that look like, the red flags that look like additional expenses that you should have had or you were over budget. So two reports or two things to look at are the bank reconciliation, which should show that what you have on your bank statements or in your bank account is what's on your balance sheet. And we'll talk about that later in our 4 financial reports to pay attention to. And then next are bank statements. You see the money coming in and going out. The boards would have been able, other board members would have been able to see that either a board president was writing fraudulent checks to herself because you would have seen images of the checks, or if you saw charges from a debit card or an ATM card for the association, you would have seen those on those statements as well. So, all right, now talking about debit cards and credit cards. My first precaution is I would say don't have one if you don't need one. In many instances, the board isn't making a lot of purchases on these cards, and the best way to handle them is to have a board member make the purchase and then get reimbursed for that purchase. But if your association uses them on, has a lot of purchases and you want to have a debit card or credit card, here are a couple of pointers. First, the debit card, in the case study, the person was able to go to an ATM every day and take out the max limit for that ATM card. So a debit card only has a daily maximum. So a person can go and keep hitting the ATM until they drain the entire operating account.
Russell, that's a lot of work.
It is a lot of, well, stopping on your way home, I'm sure on your way home, there's probably a couple places you could stop by an ATM machine.
Yeah, good point.
But what you want to do is you want to have a separate operating account for the debit card, and you can put a cap of whether it's $500 or $1,000, and that's the total limit that you have there, that your exposure is. On credit cards, you can put in a max, amount that the credit card can go up to. So that's another way to make sure that you can control expenses on those. Additionally, banks in this industry have the ability to provide notification whenever a debit card is used. So it's something as a board member, if you have a debit card for an employee or other people on the board, you might want to have those set up so that you're notified when there's debit card purchases. Now, petty cash is a slippery slope. I would say not to have petty cash because cash can go missing easily. And, from an experience, you could put cash in a little lockbox, in your office and in someone's desk drawer or in the board member's closet, or maybe you even put it into one of those wall-mounted safety boxes like they have in hotel rooms that you have in your closet or something. Well, let me tell you, I've had that happen in my management company where somebody came in and ripped it off the wall. So it's not safe unless it's bolted down to like a concrete floor. Your safe is not safe.
Were they putting millions in there?
No, it wasn't that much money, but it's just one of those things. This happened in my management company in my former life in Connecticut. But not a lot of money, but still, people see a safe and they think that maybe there is something valuable in there. So I'd stay away from petty cash. Next best practice is eliminate single person control and share responsibility. So what does this mean? So I've seen case studies where a board member, whether they were a domineering board member and didn't provide financial reports on time and nobody wanted to talk with them or deal with them and they were taking care of things so people left them alone, or a sweet person who was taking care of everything. They were the only person on the board handling the money, and lo and behold, it turns out, she had to get hospitalized. Some other board member took over and found that she was stealing money and to pay medical bills. So you want to limit eliminate single person control and put in where there's more than one person in charge of writing checks and overseeing the money. And then inside the management office, you also want to share responsibility. I've seen cases where, it's the bookkeeper, because the manager didn't want to pay the extra money for overhead for a separate AR person, a separate AP person, a separate bookkeeper, and divide duties. So segregation of duties is one way to eliminate potential for fraud. So instead, they had one person doing this, and that person never took a vacation. So that's a red flag. Everybody needs a vacation. Everybody needs a break from work. So when if a person leaves for vacation, you have somebody else that can oversee what the work that person was doing and can turn over, might spot some irregularities. So that's something you want to look into too. Next up is accounts payable. So best practice is to have two people that approve the invoices or sign off on the checks. So in the paper-based way of doing this, you have either the invoices get passed around between the president and treasurer, or two people on the board. They both sign them and date the signatures, and then they file those, and then they write a check. Or the checkbook itself has two signers on the checks, but both board members have to be around to do that. So the new way of doing that, you have online bill pay, online bill approval system, where the invoice is something that we have. Invoice comes in, gets scanned. The board, usually the treasurer and president, both get unique logins. They log in and they digitally sign off on it, and you see the date and time that each person approved the bill. So have two people, whether your practice is paper-based or online-based, have two people involved in approving bills. That would have handled some of the issues in the case studies we mentioned earlier. Next up, many management companies and some on-site offices for communities will have a check printer, and they'll have blank check stock. So you want to put that in a safe place, put it in a safe, lock it up, and have an accounting or ledger for those blank checks, because you don't want someone to be able to print bogus checks. The next is accurate geocoding. So accurate geocoding, what that's going to do is it's going to allow us, when we take a look at the financial reports in just a minute, to spot variances easier, which will make our jobs easier looking for irregularities. And note duplicate payments. So you want to have a system or process that would allow spotting duplicate payments, because you don't want to pay the same vendor twice and then not catch that. So in our online AP system, it flags vendors based on invoice number and for the association and the invoice and the vendor name. So we're able to easily spot duplicate payments so it doesn't happen. Next, we'll get into this in one of the financial reports, but you're going to compare the bills to what you budgeted that your bills would be and look for irregularities. Okay, so payroll. In one of the instances, the on-site manager paid herself. She was performing the payroll. There's Quicken and other software packages that are cheap, and so people use them, and nobody's giving oversight of that process. So the on-site manager was able to issue herself additional checks, bonus checks, and other things in the tune of over $115,000. So if you used an outside service, like a national service such as Paychex or EP, you wouldn't have this problem. A third party would be handling it, and you'd be benefiting from that. Next, the other way that you can lose money is, and this has happened to me in my management business in Connecticut. Our controller her husband had health issues. She was preoccupied with that. She forgot to file the quarterly taxes for an association employee. And so that association, one, they didn't get filed, they didn't pay the tax on time. So we owed the back tax, and we owed interest and fines. So that ended up being a $7,000 costly mistake, which of course we paid. But I would rather, I don't do payroll. I let somebody who specializes in payroll take care of that, so those types of liabilities don't happen. All right. Next up is delinquencies. So one of the ways that you lose money in an association is by somebody stealing money. The other way that you have a problem is you don't collect the dues that are due you. And so we have a couple of slides that are going to talk about this. But first off, communicating with owners, if you're not sending out an email statement or a mailed statement or a coupon book and mailed late notices, those are ways that you're communicating with owners to chase the money in and let them know what their payments are, as well as adding late fees to it. Next thing you want to do is you want to give people as many ways to pay as possible. So some people want to pay by check. Some people would prefer to go online and make a payment by e-check. Other people might need to make a credit card payment in order to keep them from going to the collection attorney or collection agency. So, you know, some board members attending right now may not have been through the last recession, but we've had a long time for an expansion here in this economy, and pretty soon we're due for a recession. And when that happens, you especially want to give people all the ways that they can pay as possible and collect those funds for the association. And part of this, next slide, would be going through your collection policy. I just wrote an article about this from the CAI magazine about having going through your collection policy, and if you don't have one, put one in place. So what a collection policy does is it outlines the process of what the charges would be to a delinquent owner and when those different things are going to happen. A late notice is going to get mailed on this date. We're going to turn over, we're going to fine you on this date, which is in your documents. And then we're going to turn you over to a collection agency on this date. So you want to have that spelled out. You want to then provide it to all the owners so that they're aware of it, and then make sure that you're doing this. I know a lot of self-managed communities especially don't do this. They don't, mailing out late notices is a pain. Adding late fees manually into an accounting system is a pain, but it's something that needs to be done. And when you're talking about late fees, a lot of documents, governing documents, have specified late fees, and the governing documents are from the 70s or 80s, and the late fee was $5. Well, nobody's going to think that $5 is a deterrent from paying late. So make sure you've got a late fee that really is a deterrent. And next thing you want to do is, if you have a problem with delinquencies, or in the future if you do, one thing you might want to know about is it is an option these days to be able to report delinquent payers to the credit rating agencies, so like Equifax. So the one thing that we offer through partnership with Sprolonga and Equifax is being able to report delinquent payers. So of course, whenever somebody gets their bills and they have limited funds, they're always going to pay the bills that report to the credit agencies first. And you know who doesn't, who always gets paid last? It's the HOA and the condo dues. So if you can change that, what we've seen is a dramatic, increase in monies collected and a decrease in delinquencies by providing this as a service to HOAs. And only the delinquent owner pays a fee for this. And everybody else that pays on time, they get a benefit to their rating, their credit rating.
Hey, Russell, before we move on, is there, don't you have a collection policy or a sample collection policy on your website for those who don't currently have one?
Yeah, thanks for asking. So I've had board members ask about, well, can you tell us what a collection policy looks like? What is a collection policy? So we put a sample collection policy on the resources page of our website, communityfinancials.com. And so you go on there, download it, and of course, in bright red on the top of it, we say, please look this over with your association attorney to make sure that it's in compliance with your state and also with your governing documents. So it's a good sample, and it's a good place to start the conversation. And I suggest do it sooner rather than later, because if we have an economic downturn, you're going to want to be prepared.
Great, thanks.
Yep. All right. Now you want to have some best practices of managing income. So separate bank accounts. So of course, property managers need to have separate bank accounts for different clients. You can't commingle funds, so that's there's a reason for that. It leads to abuse. In a lot of states, that's a law. And then for your own association, you want to have separate accounts for both the operating and reserves. It just makes it easier to, well, one, some states it's required, and two, it makes it easier to see how much you've got set away for larger expenses. The next thing is, if you don't have, some people might just have a board member is collecting checks, homeowners come over, they drop it in their mailbox, or they mail it to the management company, and they have, in both of these instances, you've got to wait for somebody to deposit checks. So there's two things. One, it takes longer for you to get the money into your account. Two, in the longer wait period, somebody could have spent the money twice by writing two extra checks out of their account, so you might not get the money. So you want to get the money in the bank account as quickly as possible, and having checks go to a lockbox speeds up income. It improves not having bounce checks, and it also reduces the maybe somebody is doing something improper with the checks, or it gets lost. Next thing is, some on-site offices or a management company will use a check scanner that reduces the time for having to send somebody to the bank to make a deposit. But the best practices for the check scanner is to destroy the checks after 45 days. So 45 days is enough time to make sure that the check clears and answer any questions, but you don't want checks with active account numbers and routing numbers laying around the office that could get into the wrong hands. One of the most important things, and I don't think boards do this as much as they should, is to have bank account access to all of the bank accounts for your association. So even if you're working with a property manager, and as a property manager, this was something I wanted to do. One, it shows complete transparency, and two, it removes questions that come back to the management office, because people can go online and see their account balances and see the money that comes in and out of the account and run bank statements. Just makes sense. You can have multiple people on the signature cards. All of them have access to view the bank account online. And then this last one, I had a client who had over $100,000 in a bank account. Unfortunately, a board member who opened the bank account passed away, and it took them over a year to get access to the funds. So a couple of reasons you don't want to have accounts that are open that you're not keeping an eye on. One, it's additional work to reconcile. Two, if somebody moves or passes away, it's going to be a really tough job in order to get access to those funds, and you probably need them. And then three, somebody might have an old checkbook. They found an old checkbook in a box somewhere. It's still live because there's still an account that's open that no one's really keeping an eye on, and somebody can write checks out of it. So close unused accounts. All right, all right, so I hear this question all of the time. The boards get a stack of paper reports, but they don't look at them. The manager thinks that the best way to impress a client is to give them the thickest package of financial reports. But usually, I suspect it's information overload, and not knowing what to look for in each report is the reason why boards don't take a look at financial reports that often. So it can be overwhelming for a board member that isn't used to looking at financial reports. So if you only needed a handful of reports, and we're saying four reports to look at, it would make your life simpler, and you would know what to look for in those reports. And that's what we're going to talk about right now.
Hey, Russell, it sounds like what you're talking about here is the classic advice I've heard, is that you want to take something complicated and make it simple. And boiling it down to four, and I think when we did the dry run on this, it talked me through it. I was so impressed with how you made this potentially complicated subject very simple.
Yeah, well, thank you. And if you have limited time, or you want to just keep the pulse on the community, you look at these 4 reports and you're going to know to ask questions, or you're going to have a good understanding of what's happening at your community. So, and as we discussed before, you have a fiduciary responsibility to exercise due care and diligence when overseeing the community and its funds, and use these 4 reports as vital tools for protection of association assets, control, and planning. And so it helps with time management. It helps you have a better understanding of what's happening at the community. And there's information on this at our website too, if you want to share with other board members so that they know how to read these things. So let's go on to the first one, which is my favorite report, which is the income and expense report, but it's the comparative income and expense report. So it compares your actual expenses to the budgeted expenses for the month, and then also for the year. And then there's an extra column which shows the variance. And so the variance is going to help you spot irregularities. And this is why the GL coding was important before. So GL coding means the line item expense code. So when you have, for example, your snow line item, you budgeted, $10,000, but it ended up being $20,000 because of extra snowstorms. Or you live someplace hot and your water bill was supposed to be $5,000, but it ended up being $10,000. Well, that should give you reason to say what's going on here. And so you're going to look for those variances and then ask questions and dig a little deeper and do some research. And you want to spot these irregularities, so then you can do a special assessment. So in the case of both the water bill and the extra snowfall and plowing bill, you want to do a special assessment when it's still cold. So it makes sense to owners why they're paying the extra fee. So you don't have to go rating your reserve account. So this is a great report to see where the money's going. Next up, we're going to take a look at the balance sheet. And the balance sheet is an important part of the financial package. It tells where the association stands with their assets, liabilities, and reserves at a particular point in time. So there's 3 key accounts on a balance sheet that board members should pay special attention to, and managers, which is the cash in the operating checking account, which shows the ability to pay your bills. The next one is accounts payable, shows how much is owed to vendors and service providers. So it's like looking at what your credit card balance is. So you want to see how much money you owe. And then the next one is capital reserves, or your reserve accounts, shows how much money is available for future capital repairs and replacement projects. So that's where you're going to be really paying attention to. Next up, we're going to take a look at a report that seldom gets to the board members. And I don't know why, but this is the bank reconciliation report is used to prove that the cash assets shown on the association's books and balance sheet agree with what the bank statement shows. The reconciliation takes into account outstanding checks that have not been processed by the bank, as well as deposits of cash that have not been processed by the bank. There should not be any difference. It should be 0. But if there is a difference, it's a flag for you to look into something further. And this report's a
Paige, this is Robert. I just lost Russell.
I did too. I was just about to say the same thing. Russell, you still with us? In the meantime, Robert, do you want to hop on?
Sure. I'll step in.
And shows who's behind.
There he is.
Russell, we lost you for just a moment. Can you do a summary of this slide before we move on?
Sure. So we're going to make sure that you have a firm handle on what's in your bank account and what shows up on your financial statements. So the bank reconciliation is going to prove that your funds and your reports match up.
Great. Thank you.
Yep. Okay, next up is age delinquency. So remember, we're going back to the collection policy and why it's important. So you're going to use the age delinquencies now to help you to follow your collection policy. And it's going to provide you, okay, if somebody has a age delinquency at 30 days old, we're going to do this step. We're going to mail them this letter. At 60, we're going to mail them a certified letter and a pre-lien letter or whatever. And then we're going to take them over to an attorney. So this age delinquency report really helps the board drive what they're going to do on collection work. And, you know, this is, like I said before, you can lose money by fraud and theft, but you can also lose money by not being able to collect your owner fees. And so having great processes, having a good collection policy, and, you know, in some states, they only guarantee collection of 6 or 9 months of past due assessments. And, you know, it can take a couple of months for the action to work itself through the courts. And if you're owed a year of money and you only get 6 months, you're out 6 months of dues. So, you know, that's why it's really important for the board to keep an eye on this report. And don't forget to look at reports with prior owners. So if you still have, you know, a lot of the software packages just do for current owners, you want to also look at prior owners, because maybe somebody sold their unit and somebody took their eye off the ball, so to speak, and that person still owes money. You may still want to continue a collection action, or you still have a collection action in process that you want to keep an eye on. All right. So bank statements, like I said before, best practice is the board should be able to get bank statements either with their financial reports on a monthly basis, or be able to log in and view the bank statements and run bank statements themselves. So another fraud, case study of fraud came up where a bank controller had given false financial reports. There was no bank reconciliation report, like I mentioned before, and they were not receiving bank statements. So in this case, it was a property management company in Connecticut, and they stole over $2 million of money. So it's a lot of money from a lot of different associations, and that's how they did it. So that's why bank statements and bank reconciliations are so important.
Russell, that sounds like just a plain free or inexpensive way to kind of keep the lights on and make it hard for the money to go missing.
Yeah, it's just like if you have your house and you went out of town, you might put the lights on the timer on the inside and on the outside, and put up a little security sign out in front of your house, and make people think twice before coming in to rob your house. So just like that, you want to get these things. If you're getting bank statements, and at least you are, you know, preventing somebody from keeping things from you. Right, next up is the reserve study plan. So whether your state requires it or not, you should have something that shows how much money you have set aside and the anticipated cost for replacements and larger capital projects. This report is far superior than just looking at the reserve bank account balance on the balance sheet, which could be deceiving. You know, you could have one paving project or a roof project, and your entire reserve fund gets wiped out. You know, many board members don't know the magnitude of what these things cost, because it's not something that we come across in our daily lives. But you know, that's why the reserve study is there to help guide you. And of course, you can talk about that further in coming slides. So you want to know your numbers. You know, just trusting the board treasurer to tell you what the numbers are, or the property manager, is not enough. So you should know what your budget is. You should know what take a look at that comparative income and expense line items and see if there's what size it should be, what is the variance, and then ask questions. How come we had a variance? Well, because we used more water, you know, because we put in new trees and we had to have them on irrigation for a week. So, you know, just ask those questions. So the variance helps with that. And then, you know, you want to be looking at, you know, at all times your account balances. Know, just like you do with your current account balance or credit card statements, you want to know what those typical balances are. So if you look at the balances the following month and it looks like you have $50,000 less money, or your credit card statement is $10,000 more, that's a red flag. So take a look into that. So just take a look at this, and if you typically have 5 delinquencies and you spike up to 20 delinquencies, what's going on. So just kind of know what's happening, and it's good to have that oversight. So we covered a lot of ground. There's a lot to do with collections and age receivables. Then there's a lot to do with payables, and then banking and financial reporting. But you're not alone, and there are resources out there. You can go to our website, communityfinancials.com, look at the resources page. There's lots of sample documentation and blog posts and other things and videos. You can also go to CAI. They've got lots of written and reports and books and things that you can get to help understand things better. And then also just ask questions. We're all here to help. Professionals are here to answer questions for board members and for other managers to just just help answer their questions so they can do a better job. So we're here to help. Just ask for it.
Fantastic. Thank you, Russell. Well, I want to show our audience something that I thought about when Russell and I were working up this material. When he was talking about the 4 key reports, I started thinking of an analogy that made a lot of sense to me, and it's like what I do when I'm driving, the multiple things I do to stay safe. One is to look ahead at the road, know what is happening in front of me, keep an eye on my speedometer to see how fast I'm going. I'm aware of my instrument panel to make sure nothing is flashing, to make sure that everything's doing okay, and to be aware of my environment, to know what's going on around me. And that's what it started to sound like when Russell was talking about the income and expense report. It seemed like being aware of what I'm seeing in the roadway ahead. Balance sheet talks to you about where your money is, how fast you're spending it. That's kind of like your speedometer. The bank reconciliation is kind of like your instrument panel. When it doesn't go to 0, that's the flashing yellow light that says perhaps you're low on fuel. And the age delinquencies is kind of like your mirrors, knowing what's going on around you. And that made a whole lot of sense to me. It made it sound so intuitive, like the normal thing that we're supposed to do at the association. And then I don't want to focus too much on just hitting budgets, because you do have a duty of inquiry as a board member to reach out and ask, what is the right amount of reserve contributions at our association? How much is enough? Because you don't want to get into the situation where you're hitting your budget number, but it's a bad budget number. It's fundamentally an underfunding number. Because if you're hitting your budget number, that's a bad number, you're going to end up not having enough cash at your association to do what the association needs to have done. So we recommend something fiscally responsible to do, as Russell indicated earlier, is be aware of your reserve situation. At budget time, look at what your recommendation is. Make sure it's a recent recommendation, not something from a few years ago. And then work out a plan. Being fiscally responsible means that you have adequate cash, means sufficient cash to do your reserve projects over 20 years. And that may take some adjusting. Sometimes what I'm showing here is a full funding plan. You may not want such a conservative plan. You may want something else. You may have a different reserve balance than you had last year. You may have had some expenses that went up or down. And so every year you've got a new challenge to lay out a plan to show that you are adequately funding reserves. And I want to talk about a new tool that we have at Association Reserves called UPlanet. And it's exactly that. It's a online reserve calculator, so you can take your reserve plan and adjust it. You can test what happens if you move some money from operating into reserves. You can test what happens if you change a component cost or the timing of that. I think Russell said the asphalt project. So it's a neat little tool, but it helps put the power into your hands. It's another tool, kind of like how your eyes are scanning when you're driving in front of you, speedometer, instrument panel, and mirrors. It just helps you take advantage of what's going on at your association and help you plan responsibly. Because a wonderful association, a peaceful and productive association, is one that not only looks good, but one that has good financial bones. And it is money that runs an association. It's the lifeblood of an association, and we want to make sure you know what the right things are to do and have good, strong financial practices. And so for more information on Russell and how his company, Community Financials, helps associations all across the country with their finances and their reporting, and then also check to see if his company can provide some cost-effective solutions for you. Just go over to communityfinancials.com and visit them. See what they do for others and if that's appropriate for you. And of course, you can go to the Association Reserves website at reservesday.com, where you'll find access to articles and other webinar recordings that'll help your association make wise decisions about reserves. We want you to be making wise decisions about your future. At that website, you'll be able to request a proposal to update your reserve study, which comes, of course, with free access to UPlanet. And that brings us to our Q&A time, which will be handled by Paige Showerman, our moderator today. So Paige, the microphone is all yours.